The shockwave that rattled the gaming industry is about to echo again as DraftKings stumbles through September. Find out what made September so critical and what Jim Cramer really thinks about the future of DraftKings as one overlooked shift could flip the momentum completely.
With the stock now down almost 28% from its last month's peak, it closed at $35.37. You know, the stock is now down almost 5% for the year. What is behind what I regard as pretty much of a breathtaking decline? Okay, I want you to keep in mind that September is a pivotal month for the sportsbooks because it marks the start of the football season. It's make or break for these companies. A year ago, DraftKings struggled during this period because too many people were betting the favorites, and the favorites kept winning. People love to bet the favorites. So the bad news, and by the way, that is bad news for sportbooks. When more favorites win, the sportbooks experience higher losses. More parlays are also likely to hit when the favorites are winning. That also is bad for the house. And this September, NFL favorites won at an even higher rate than last year, at least until last night's surprise victory by the 49ers. This is supposed to be a temporary problem. But if it keeps happening, you got to wonder if maybe the people placing these bets are becoming more astute. At the same time, DraftKings and its compadres are facing more competition from online prediction markets. The prediction markets, especially Polymarket and Kalshi, let you bet on nearly anything. There was a whole South Park episode on it recently. You often hear about people betting on political outcomes, but they cover all sorts of stuff, including like who will win Time Person of the Year for 2025. Right now, AI is frontrunner. I guess no job is safe. More importantly, they're doing sports betting because why not? Instead of traditional odds, bets are quoted based on what you need to put down to win $1. For example, last night's Kalshi line on the 49ers to win was roughly 30 cents, meaning that each share would cost 30 cents to win $1. This is different than how traditional sportbooks operate, but it's ultimately very similar in terms of payout, and it's much easier to understand. Plus, these platforms really operate peer-to-peer betting markets. They give people a marketplace to bet against each other, rather than taking the opposite side themselves. That they make their money by taking a small transaction fee from each bet or by taking a percentage of the winnings. Long term, they could allow the prediction markets to offer better odds than the online sports books like DraftKings or FanDuel. But the biggest competitive threat here is the lack of regulation. A company like DraftKings is heavily regulated by gaming regulators in the states where it operates, but platforms like Kalshi are treated as designated contract markets by the CFTC, which means they're treated more like a stock exchange than a traditional sports book. Because the prediction markets don't take the other side of the trade, though, they're not actually gambling. It's not gambling, so they don't need to navigate the patchwork of state-by-state licensing laws. While DraftKings is desperately trying to get approval in states like California and Texas, people in those states can already bet on these games via these prediction markets. And though Kalshi had $260 million in trading volumes last Sunday, already surpassing the previous record on Election Day last November. Now, these concerns reached a fever pitch during Monday Night Football, shortly before the kickoff between the Jets and Dolphins on September 29. Kalshi temporarily rolled out a new feature called Build Your Combo. While that might sound like a new offering from Taco Bell, it's essentially operated as the same game parlay, giving users the ability to combine multiple types of bets into a single contract. What's so dangerous about that? Well, people love these parlays, and they're immensely profitable for companies like DraftKings. So this kind of competition is terrible for them. And that's why the stock plunged 11% on Tuesday, and it's been sinking lower ever since before finally stabilizing today. That said, I think the sellers, frankly, might be overreacting. Compared to DraftKings, the sports betting offerings from the predictions markets they're pretty bare bones. Some analysts have defended DraftKings and asserted that the headline volume numbers we're getting from Kalshi might not be a fair comparison to traditional sports books, even the structural differences in making a market versus operating a peer-to-peer marketplace. Other analysts seem to think that the argument is bogus, though. While these prediction markets can operate in states where sports betting remains illegal, that also makes it hard to tell if they're actually stealing much actual business from DraftKings. According to Jeffries, a quarter of Kalshi's revenue came from Texas and California, where DraftKings doesn't operate. When people have a choice between the two, they tend to go with a regulated sportsbook like DraftKings or FanDuel. Meanwhile, analysts at Oppenheimer estimate that roughly 40 to 50% of Kalshi's volumes come from its partnership with Robinhood, which suggests that much of their user base is generally new to sports betting. The analysts think that this could either be, even be a tailwind for the sports books down the line, similar to how DraftKings and FanDuel saw user growth tick higher following the launch of ESPN Bet. because it lured more people in, and these people eventually migrated to better platforms. That's not even factoring in the dizzying legal situation that the prediction markets find themselves in. As you might be asking yourself, how is all of this even legal? Well, it turns out many states are asking the same question, with Kalshi involved in a host of lawsuits across several states. They got some bad news just today as a federal judge in Nevada, a judge that Kalshi has a pending case with, ruled sports prediction markets do not qualify as swaps in the case with Crypto.com. That doesn't bode well for Kalshi. Just to throw one more wrinkle into all this, Donald Trump Jr., that is, sits on the boards of Kalshi and Polymarket. So maybe they'll have more luck if they can appeal to the Trump-friendly Supreme Court. I don't know. Look, I don't want to speculate on the outcome here, but you should be aware of the flimsy legality of the prediction market situation before you panic and sell DraftKings down here. After all, there's a reason why the online sportsbooks haven't gotten into prediction markets. They're probably worried that when the regulators finally come down on these platforms, they'll come down hard. If anything, it might spur some states that are holding out to potentially legalize traditional sportsbooks so they can at least get the tax revenue. If their constituents are already gambling, I mean, really, what's the harm? So where do I come down on this? Despite today's rally, DraftKings is still down almost 5% for the year. It's down a whopping 28% from last month's high. I've spoken with CEO Jason Robbins on multiple occasions and like the direction the company's headed longer term, which means this could be a buying opportunity. So here's the bottom line. I'm not backing away from this stock. I think the predictions market fears are overblown here. So if you don't already own any DraftKings, I'm telling you, you got my blessing right here to put on a small